Good afternoon, everyone. Thank you very much for joining us. This is Startup Finances Q&A. It's our 10th session and also our last session of all our startup Q&As for 2025. I'm going to take a break and resume on the 12th of January. So we'll give people some peace. I've got three amazing people to give us advice and take any questions we may have today in terms of finance. So whether you are a UK startup that has got some help on that, or perhaps just a founder without anybody to help you on the finances of your startup journey, this is the place you want to be. We're going to take any questions you may have until 1 p.m. So that's for the next 52 minutes. And the way it will work, it's quite straightforward. We'll have some quick intros, then we'll go on to some do's and don'ts when it comes to early stage finances. And then we'll go on to some questions from the audience. In terms of questions, they can be on anything to do with startup finances. There are no wrong or right questions for that matter. It's a learning curve for us all, and there's no need to be shy either. Now, if you do have questions, the best thing to do is to drop them in the chat. We'll give you the mic, you introduce yourself, and then fire away with your question. For those of you that are on the live streams, whether you're on LinkedIn, YouTube, Facebook, Instagram, or Twitter/X, please bear in mind that unfortunately we are unable to monitor your questions there. So you would have to join us here on Microsoft Teams to ask whatever question you have on finances, whether it's about projections or maybe accounting or taxes or rewards or whatever it may be, really, your P&L perhaps or cash flow. And there are a few ways you can do that. One, you can click on the links that are on those live streams, or simply go to our website, startuptoscaleup.club. Again, it's startuptoscaleup.club. You click join. It's a quick registration on Luma. And there on Luma, you'll find today's link. Now, for those of you that manage to do that, I would also like to encourage you not to leave it for last minute to ask questions, because we will run out of time. And at exactly 1 p.m., so in 50 minutes from now, we will wrap this up. Now, in general, what we tend to do is go through 6. Yep. So we've got 6 events that we normally run, 6 regular events, helping founders with whatever questions you have on your startup journey. On Mondays, it's talent. Tuesdays, it's product and tech. Wednesdays, it's growth. Thursdays, it's fundraising. Second Friday of each month, it's UK startup law. And third Friday of each month, it's UK startup finances, all from 12 to 1 p.m. UK time. They're all available on our site, or there will be rather available on our site, startuptoscaleup.club. And I guess without further ado, let's get on to some quick introductions. My name's Anton Call. I'm an Albanian in London working with startups normally right after they get investment. I embed within their teams and help them hire and keep the right people. I also do some growth advisory work with a few other startups and accelerators, and help some angels and family offices with their due diligence and their assessments.
Hello, I'm Sophie. I'm a fractional CFO, and I am the founder of a firm of fractional CFOs called Wright CFO. We're a group of 9, and we help businesses grow and scale and all that good stuff. And we've been around for 11 years, and yeah, happy to be here.
Hello, I'm Harriet Formby. I am also a fractional CFO, chartered accountant, business advisor, etc. I run Below the Line Finance, which is a fractional CFO practice, and essentially that involves supporting many startups and scale-ups and more mature companies, ranging from, raising investment, managing growth, navigating cash flow difficulties, and typically that will be in the kind of often quite creative sectors, media, tech, professional services, and retail, quite a range really. And I had prior experience in much larger organisations and sort of private equity backed ventures. So yeah, really good to be here as always.
Hi, my name is Samuel. It's a pleasure to be here again. I'm a fractional CFO. I run Arthur Hammett Accountancy and ScaleUp CFO. I help founders get clarity on cash flow, scale profitably, and make confident decisions on their numbers. Thanks for having me.
Wow, we've got an absolutely golden team. And just before we go into the questions, I'm sure you've seen some great stuff out there, but not so great too, that founders tend to do when it comes to early stage finances. What would you say are your biggest do's and don'ts?
Sure. I would say for a do, I'd say when you're in the early stages, it's nice to kind of work on the brand and the networking and that sort of side of things. But it is important to treat the finances as an ongoing touch point, not just a tick list of great, we've got a business plan, we've got a cash flow, we've got a budget or something. It's certainly a document that you should be reviewing regularly and updating regularly, because your business is going to evolve so much in variation from probably the assumptions you made right at the beginning. This is something you should be looking at on at least a monthly basis, I believe. And the second part to that is that the don't do it on your own. Make sure you've got access to, suitable advisors, turning up to things like this is great as well, asking questions, because obviously there's certain things that you want to be getting right, which with the right sort of input and advice early on is going to make sure you're on the right path to success.
For me, the first thing is have control of your numbers, clarity on your numbers, even very early on. Get confident and with software such as Xero and QuickBooks, monthly reviews of your accounts. It will serve you well as your business begins to grow. So that's a do's. Don'ts is don't listen to everybody who claims to be a finance professional on social media. That's my do nots.
I really like that last one. So I've got a couple of do's. So one of them is to automate your accounts receivable immediately, like from day one. So if you use Xero as an example, if you use Xero, you raise your invoices, you can just in the settings, set it up so that, a statement goes out or a reminder goes out if they're late, another one, and you can get another one in 7 days, and you can tailor all this kind of stuff. And it's just automatic, which I think really helps. You can, and things like, being allowed to let people pay in different ways or collect by direct debit, that kind of thing. Another do would be, well, similar to what Sam said, review on a monthly basis. This is more like, a lot of people do a budget once a year and then they forget about it, and it's not really worth anything because things change so fast. I would suggest implementing a rolling forecast, and you update it every 30 days, and you look at actual costs that are happening and make adjustments. Look at your pipeline and honestly and genuinely think, is that going to convert? Is it not? What's the likelihood? And just keep updating it so you really know a good kind of honest picture of your business. I would say, so I normally say don't do everything yourself. Definitely outsource some of the finance stuff. But my don't is actually not to, if you're a big fan of the outsourcing, do not outsource the understanding of your numbers. So it's great for someone to have a cash flow and live and breathe your cash flow, but actually you need to understand it too, and you need to know what every penny means.
Well, that is amazing. Thank you very much from all three of you, team time. I reset the conversation for those people that have just tuned in. So this is Startup Finances Q&A. It's our 10th UK Startup Finances Q&A that we've done. We're here to help founders with whatever questions you may have in terms of that journey of yours, especially the early journey of startup finances. I've got three amazing people with us today to take questions on anything to do with your startup finances. And there are no wrong questions, or right ones for that matter. There's no need to be shy. It's a learning curve for us all, and your questions today can be on anything to do with your finances. So perhaps you might want some clarity or ideas on your cash flow, budgeting, profit and loss, payroll, benefits, taxation, bookkeeping, VAT, auditing, loans, banking. You want to make sure you're not being defrauded, or you want to talk about projections and forecast and basically templates and all that jazz. There really are no wrong questions. All you have to do is drop your question in the chat. We'll give you the mic, you introduce yourself, and then fire away. Now, if your question today is not on finances, then you'll have to save them for next year. The reason being is that this is our last Q&A for 2025. We will, however, be back and resume on the 12th of January, where we'll carry on as normal with our 6 flagship Q&As, and that is Monday's Talent, Tuesday's Product and Tech, Wednesday's Growth, Thursday's Fundraising, second Friday of each month is UK Startup Law, and third Friday of each month is UK Startup Finances, as you can see today. They're all from 12 to 1 p.m. UK time. They're all available on our, or they will be rather, shall I say, all available on our site, startuptoscaleup.club. So again, it's startuptoscaleup.club, where you can go and and RSVP or register to future sessions. In the meantime, what you may want to do, especially during this break, is to perhaps connect with others in our community. We've got some amazing groups on WhatsApp that you can connect with fellow founders, with investors, with operators, and of course, our second to none panelists/mentors. At the top and bottom of our site, you'll find a WhatsApp icon. If you click on that, you'll then be able to join us. Now, for those of you that are on the live streams today, whether you're on LinkedIn, YouTube, Facebook, Instagram, or Twitter/X, unfortunately, we're unable to monitor your questions there live. So if you do want to ask anything to our panel of CFOs and accountants, you'll have to join us here on Microsoft Teams. It's audio only, which means you can tune in from anywhere via any platform or device. And it doesn't matter whether you're perhaps going to pick up your kids from school, or maybe working from a shared office in Shoreditch, or walking your dog in Surrey, or cooking lunch in Liverpool, or having lunch in Bristol, or perhaps changing baby nappies in Glasgow, or maybe trying to work out from somewhere in Nottingham. There is really no barriers to this. It's audio only. Quickest way to do this is either through the links that I've shared on the live streams, or simply go onto our website, startuptoscaleup.club. You scroll down a little bit, you'll find today's session, which is Startup Finances Q&A number 10. You click join. It's a quick registration that gets you onto Luma, and through that on Luma you'll be able to find today's session. So I guess without further ado, it's time to go on to our first question. I'll read this out loud. This is interesting. Coventry, or a tracking variable. This is about tracking variable COGS in dynamic business models. So it explains here, because I didn't know this, luckily. COGS, it's short for cost of goods sold, right? So this is a travel tech startup. They offer customized group travel packages to corporates. They're based in Coventry. The challenge they have is that the company faces difficulties in tracking and recording variable costs of goods, shortly known as COGS, due to fluctuating supplier and logistics expenses. I don't know why, but it sounds familiar. Did we have this question before, ladies?
I'm not sure.
No. I'm sorry, ma'am. Everything sounds the same now. It's that close to Christmas. Okay, so the company faces difficulties in tracking and recording variable costs of goods sold due to fluctuating supply and logistics expenses. The situation is that they are generating revenue, they've got some seed funding, and they've got high client retention rates. And then the question goes, we're a travel tech startup with variable COGS who can't afford a finance part-timer. How can we track and record these costs in our P&L to maintain accurate gross margin calculations? Is there anything specific, brackets, tools, or practices, such as dynamic supplier cost tracking, integrated expense management systems, or taxman-approved cost allocation methods that we can adopt to streamline reporting and improve financial accuracy? Holy moly, I am glad I don't have to answer this.
Looking at the question, my interpretation of this is that the company is arranging travel on behalf of corporates, and therefore they are incurring the costs of putting together those packages, and obviously looking to make a profit on doing that, because that's the point. So what's going to be important here is firstly to make sure that the costing is done in a detailed way, as in you've got a good system initially when you're quoting for a package to say, it could be as simple as an Excel template that is the components of what's involved in the supplier costs, a way of putting through time of people that are working on it, or if it may be more systemized and automatic on if it's a website based thing. I don't know how much human intervention there is, to make sure you've got your pricing right on a customer level. In terms of actual, if you're going, okay, what's our monthly profit and loss, what we need to make sure here is that you are probably going to have a mismatch between the timings of receipts of the money from your customers and the costs going out of the business that relate to say the events and the travel at different times. And the problem with this is it's going to make, if you were looking on a month by month basis, it's going to look strange potentially if you leave things as they are, because you will have income coming in one month but the cost in another month. So that means your profit and loss will be going up and down and you won't really be able to tell where you are. So what we'd be looking to do here is to match your income and your expense together. So for example, if you're taking money from your customer in advance and you're not delivering on that travel for some time, for example, then you'd want to essentially, and it's going to be tricky if you haven't got somebody, a finance person in the business and you're not able to bring somebody in sort of externally part-time or whatever the setup is, because it is a bit technical to do this. And essentially that's what you'd want to be doing is to match things up. And obviously, from a simple level, you need to have it might be that you have your P&L structure would also need to be organized in a way that you recognize that, the different types of cost. So you've got your sales categories, different types of cost to get to your gross margin, but you would need to be doing some accounting adjustments to ensure that you're matching up the costs with the income. There will be some systems to kind of help you with that potentially.
I don't know what accounting system you have. I always use Xero as an example because I think 90% of our clients use Xero and it's easy to use. But so the first thing is you can design your chart of accounts, which is like all the codes that you put everything in. So your revenue, your sales, your expenses, whatever. And you could create some extra ones. So you have like sales for product A, cost of sales for product A, sales for product B, cost of product.
Is that in Xerox, Sophie?
Yes.
Sorry.
Yeah. Well, you can do that for anything. You can do that for
Xerox,
any accounting, any accounting system. We'll do that.
Can you do that on Excel?
Yeah, sure. Yeah. Why not?
Okay. Sorry.
Yeah. Can't say why not.
I'm just kind of trying to strip it down to the absolute basics if they had to, because I have no idea what their situation is. But because they said they haven't got anyone in finance there.
So what I was going to say is that there's other things you can do for instance, if it was Xero, I mean, you can do this on Excel if you want to, but you can then for instance, like tagging, you can tag an activity. So sales of product A in Germany, I don't know, whatever, there's different things you can do. And what that allows, so if the setup is correct for what you want to see in your business, and this is really how you have a good look at your gross margin, then you can run little mini P&Ls of all your products and services, and you can really get a good idea of what's making money, what isn't. The key there is to have this set up properly. All your supplier invoices, all your expenses, everything, it's going into the right place and being coded correctly. If the data is clean, then you get wonderful results and reporting and great information. So I don't know if the founders are doing the finance or who's doing the bookkeeping, and I know you can't afford someone part-time going, on a rolling basis, but I would suggest, if you can, even just investing a couple of hours of a finance person to come in and look at your setup. Talk to you about what are you trying to look at here and what your setup is. And then they can just, that's something we can do, but they just do a report, and you either pay them to do it or they send you instructions and you do it yourself. But I think that's, if you really want to look at your margins, you've got to be able to set up the whole system properly.
I agree with both Harriet and Sophie. This is very common in travel tech. I once worked for a travel company, especially when your costs move with every single trip. So the main issue here is not really a finance problem. It's more so a cost attribution problem. Both Sophie and Harriet have alluded to this about our charts of accounts, having it correctly with the company that you're running so that it's easy for you to allocate all costs. But I think that the biggest fix as well is to treat every trip like its own P&L, right? So what you do is give each booking like the charts of account and ID and allocation it goes to, and then make sure every supplier's invoice and expense or reimbursement is tagged to that trip. So if a cost can't be linked to a trip, then it sits in a cost of goods. I mean, it shouldn't sit in a cost of goods. So from a system point of view, you don't need anything fancy. As mentioned beforehand, I think Xero and QuickBooks, plus a business card. Not sure if any of us have heard of Pleo or Revolut, and these are good cards as well that you can use. And the trick here really is just discipline. So business cards like Revolut and Pleo, and then just tagging the cost at the point of spend, not at the end of the month, right? So that you can track every single one of these costs and know what each cost relates to and what travel it relates to as well. So where cost lands late, you estimate and accrue them into the month, and into the month the trip actually happened. You can actually capture each cost as it relates per trip.
Another costing question, hopefully it's not too similar. This is, okay, allocating shared costs across revenue streams. They're a agri-tech startup producing precision farming equipment and, and also analytics subscriptions. They're based near Swansea. The challenge they have is that the company struggles to allocate shared costs such as R&D and marketing expenses across its hardware and software revenue streams. So basically, again, situation is revenue generating, bootstrapped. So they're bootstrapped with an expanding customer base. And the question is, we're an agri-tech startup offering hardware and subscription analytics. How can we allocate shared costs accurately in our P&L to reflect the true profitability of each revenue stream? What UK-specific methodologies such as activity-based costing or departmental profit segmentation should we employ to align with UK GAAP and improve financial decision-making? Are you big enough to talk about departmental profit segmentation? Not sure. Okay, whoever starts, if you can explain again what GAAP is for the audience, please.
GAAP basically is a generally accepted accounting practice or principles. Basically, what is it in plain English? And it's just the standard by which certain accounting practices are held. And that's it in a nutshell. Now, to answer the question itself, this is a common question. And I think practically the cleanest approach is to separate your P&L by revenue streams first. So hardware and subscriptions, for example, and then deal with the shared costs deliberately. So, for example, if we say research and development and marketing, right, I'd avoid the standard arbitrary splits. Instead, I'll use simple drivers. For example, if you've got R&D, R&D can be split based on engineering time spent on hardware versus software. Right? So marketing can be allocated based on revenue contribution. So really, these are just the things that if you've got an accountant or if you've got a professional, they can easily sit down with you and help you split this based on the operation of your business. In most cases, when it comes to things like UK GAAP, it's not perfection they're looking for, but more so accuracy with a level of explanation of what you're doing.
I don't have a whole lot to add to that. I think that was well explained. When I've done splitting of R&D costs in the past, we've, similar, it was time. We did hours. So we had a lot of staff working on different things. And so we worked out their salary and benefits based on time spent on this and that. And that's how we split it. And with marketing, revenue base is good. I would also just kind of question, are you spending the marketing for both revenue streams together? I would have thought maybe if you're promoting the hardware, then it might be a different spend anyway. But if you're spending it together and it's all mixed up, then revenue share is a great way to do it. Definitely set up your P&L so that you can clearly allocate everything separately. Totally agree with what Sam said about simplicity. You don't need anything overly high tech or overcomplicated.
We've had some great answers. I was just going to add on in terms of marketing is about splitting marketing between genuine overheads, which is to do with the whole business, and for example, maybe website and general campaigns. And then it would be relevant if you are doing something like PPC, pay per click, that is linked to the specific revenue generating activities of the different streams, then it would make sense to allocate those in line with the activities that they relate to on a different, so basically split up your marketing. You need a sensible balance here with what you can attribute and also acknowledging that this is one business essentially. So you're not going to be splitting up every single thing necessarily entirely.
This is about resolving multi-currency discrepancies across systems. They're a clean tech startup exporting energy-efficient water filtration systems to Europe and further afield. They're based in Plymouth. The challenge they have is that the startup's accounting, invoicing, and payment systems generate multi-currency discrepancies, complicating cash flow tracking and financial reporting. So the situation is that they're a revenue-generated, seed-funded with international clients, mainly in Europe. So the question is, any ideas on how we should reconcile discrepancies across accounting, invoicing, and payment systems to produce accurate financial reports for our clean tech startup operating in multiple currencies? What UK-focused tools such as HMRC-compliant multi-currency tracking software or exchange rate automation integrations should we prioritize to standardize data and maintain cash flow accuracy? And I've just realized they put another line, which is any other ideas would be welcome.
If we're talking about different points in time, and there naturally will be some variation. For example, the invoice arrives here, but we pay it in 30 days. The kind of spot rate, the exchange rate will actually shift. So that there is going to be a level of movement if there's, variations in time when things are happening. In terms of actually tracking things accurately, if you are using something like Xero and you've got the full multi-currency plan turned on, this will be working for you in the background to translate things to different rates. And I think the important thing sort of underlying that is to make sure that if that the different systems, for example, you might use Dex to bring across invoices and then they publish to Xero. You want to best you can align that the source of the kind of FX rate is going to be the same. So you've got the same FX rate used, but you will also need, in terms of kind of like budgeting, cash flow planning and reporting, you're going to need to probably leave a buffer for the fact that there is going to be differences due to timing of what something means. And it could be something, it's a wider issue, but it could be something that you look at in terms of, well, do we want to actually invoice, for example, if you're in the UK and you're somehow being paid in dollars, you invoice in pounds and get them to take the hit. Or it might be just something to think about is where does the burden fall on that? And it is something you'll always need to factor into your pricing, that there is going to be a discrepancy, differences if you are working in multi-currency, and making sure that there is room for fluctuations, and that, when things change wildly, that you have the ability to make room for that, update things, or pass the variation on to your customer if it is talking about the sales side. So hopefully that's a good starting point.
So obviously you have your base currency in your accounting system. So presumably it's sterling, and you have your multi-currency turned on. You can invoice in whatever currencies, and in the background the accounting system will say that those amount of, say, dollars are this amount of pounds. That's fine. The other thing to think about is also whether you have multiple bank accounts. So if you're I'd be curious to know that if you're invoicing in euros, are they paying into a euro account or are they paying into a sterling account? Because if they're paying into, say, a sterling account, you've got another additional layer where you could lose or gain in FX. So yeah, I mean, I don't know of like any HMRC compliant tracking software particularly. I just think this is your accounting software. It pulls the rate of the day, so you don't have to worry about that. You can also, think of, I guess you have to watch quite carefully what the currencies are doing. If you're purchasing in one currency and selling in another, is one going up, one down. I've seen a business really was doing okay, but the margins were slim, and it just fell on his knees. The month after the I don't want to bring Brexit up, but I am. The month of that, just the the voting happened for Brexit, the currency dropped so much that then the margins were so slim anyway that FX just kind of crippled the business for a while. So you do have to be really careful. Check your bank account.
Our two guests have really answered this question really, really well. I think the only thing I'll add is discrepancies. They really just show up usually because invoices are raised at one exchange rate and payments land at another one. So what tends to happen is that somebody tends to manually adjust the difference, and that's where the biggest problem happens. Some of these softwares we've mentioned here, the solution really is just automation. Let the system record the FX gains and losses separately rather than forcing them into revenues or costs. If you did that, most of these discrepancies won't show up. And from a cash flow point of view as well, I also separate operational performances from currency noise. So it does track the underlying margins in the local currency, but report consolidated performance in GBP.
We'll go on to our last question, I think. This is a question that I encounter in a ton of conversations that I have with founders. Most founders, to a certain extent, including yours truly, tends to struggle with this. And we've received a ton of questions since we started the finance Q&A, and actually even before, about how to forecast and properly handle customer acquisition. Question is about forecasting customer acquisition costs for SaaS startups. They're a SaaS startup offering team collaboration tools for SMEs. They're based in Cheltenham. The company struggles to predict customer acquisition costs, or as it's known, CAC, accurately due to variability in marketing performance and conversion rates. So the situation they're in is that they're generating revenue, they're seed funded, they've got a focus on expanding into new verticals. So the question is, how can we forecast customer acquisition costs accurately to ensure our financial projections remain reliable and investor ready? What UK-specific factors, such as industry CAC benchmarks or local marketing cost variations and channel-specific ROI, return on investment analysis, should we incorporate into our projections to refine growth assumptions and maintain credibility? If you've come across any formulas or any tools that does this well, I'm adding this now. I think it would be really useful to go into it.
Interesting that you mentioned tools, because actually that is my go-to. There's a software called ScaleXP, and it speaks to Xero. I think it speaks to other systems, but I'm not entirely sure. It's something one of our fractional financial controllers put in a couple of times with businesses, and it works really well specifically for SaaS. And it does a couple of things. One, it does all the kind of revenue recognition for you. So it'll journal it all into Xero, and it'll work out everything and do it all for you. So that's brilliant. The key thing is there is a dashboard. As part of the setup, you put in, all the metrics that you need. And with SaaS businesses, especially if they want to be investor ready, I mean, this dashboard is like just really important. It's got everything on there, all the KPIs that you need, and it's updating it live. So instead of spending, and
how expensive is it, Sophie?
From memory, I can't remember, but it's maybe a couple £100 a month, I think.
Okay,
so it's not nothing, but it's not cheap, but it's also not extortionate. But if you're looking to invest, raise investment, or to exit, or that kind of stuff, and this kind of template is just kind of gold. Check it out. In terms of the actual formulas, I mean, it is all formulas. You can just bonus, but yeah,
definitely, perhaps more for investors and bigger companies than startups, perhaps. But it sounds really good. Thank you for that, Sophie.
The way to make it forecastable is to break it down into components, channel by channel. For each channel, you model 3 things, is what I'll start with: cost per lead, conversion rates, and payback period. That gives you basically a CAC range rather than a false sense of precision. I tell you something. I was listening to our guest just now, and even that tool, I had to write it down because we've got a client that's actually going through something. So thanks for that. I've taken up that tool as something that I'm going to possibly look into for that. Sorry, back to my point as well. From an investor and a UK GAAP perspective, I think what matters is your assumptions are evidence-based. So what you would do is use your own historical data first, and then sanity check it against UK benchmarks for your sector and vertical. So don't leave with benchmark data, use it as a validation, not your foundation.
Sometimes we think that financial data is to do with sales and expenses, etc. But this is where I think it's really important to make sure that you're talking to whoever it is that's responsible for managing the kind of lead generation. And the people doing the assumptions and the forecasting are talking to them and saying, like, what is the strategy? What's happening? What are the results looking like? What are you seeing as the trends? Why are we doing this channel over that channel? And what's that going to do? And for example, if it's not been performing as well as hoped, then you really want to be quizzing them on saying, what's the strategy? It might be that you've got external consultants doing it. It might be that you've got somebody in house who's responsible for this. But you want to be kind of grilling them a bit as well on what is going on and what they see coming up, because they're going to be closer to it than you are, essentially.
Wow. We are now at 12:59. 1 minute to go before this is the top of the hour. And now it's 1 p.m. And this has been our very last Q&A for 2025. What a year. This year, we started our finance Q&As. Despite having done this for over 4.5 years, i.e. the startup Q&As, we only started finances this year, and I couldn't be any more grateful to the panelists, especially you three who've been throughout most of the Q&As we've had. So thank you. Can I get some parting words before I let you go? Maybe we can start with the ladies of the house.
Thank you for having me again. It's been really good to be involved this year, and also some to shout out Andrea, who has been with us for quite a few sessions. I don't think she can make it today, but she's been on the panel a lot as well. The main takeaway, I think a lot of people will be reflecting on their goals in the business for 2026, and it's a good time to look at your finances and maybe what you want to change for next year and start to think about what that might look like. Obviously having a break over Christmas, but that is a great time, isn't it, to reflect on what's worked well, what's not worked well, and perhaps there's some things that we've mentioned that you might have thought, well, I'll do that one day, but perhaps that's something to start scheduling in and seeing, when you might be able to, particularly around these questions, when you might be able to look at that when you come back next year. And thank you.
I've had several clients recently who are all looking for kind of debt finance, and they're looking for loans, and what has become clear is the best time to raise is when you don't need it.
This has been fun. Last but not least, Samuel, please.
My parting words is that it's been an absolute pleasure to share this platform with yourself and some of our esteemed guests right this year. This may be less accounting, less technical, but anybody that has started a business in 2025 or you planning a business in 2026, my advice is to go for it, go all out, and don't look back. What I find with investors is they're not necessarily looking for flawless forecasts. What they're looking for is our founders who understand their numbers, their risk, and their levers, and can explain them very simply to investors. So my message is just go all out. Don't turn back. You can do it. Thank you.
What an amazing session and a brilliant team to go through it with. Thank you very much. Really appreciate all three of you. Thank you, Harriet, Sophie, and Samuel. I wish you a great end of 2025 and a brilliant start to 2026. And if you celebrate them, a Merry Christmas and a Happy New Year too. Huge thanks to everyone that tuned in. Thank you to all the panelists that have helped us this year. We've had quite a few sessions and we've had a few thousand people. The average has been much lower than previous years. So we've had about 100 people in each session. And I have to say most of that has been via the live stream. So perhaps the goal this year is to have that many people, what I would call natively, i.e. here interactively on Microsoft Teams. So bear that in mind next year, founders. Now, before my parting words, a couple of quick things. We will resume now on the 12th of January with Startup Talent. So we run 6 regular sessions: Mondays Talent, Tuesdays Product and Tech, Wednesdays Growth, Thursdays Fundraising, second Friday of each month it's UK Startup Law, and third Friday of each month is UK Startup Finances. They're all from 12 to 1 p.m. UK time. They're all available on our site, startuptoscaleup.club. Again, startuptoscaleup.club. And then what you do is when you're on that site, you just scroll down and you find the sessions that you prefer to join. You click join, and there you'll be able to register via the Luma schedules there. The idea is quite simple. You see, unfortunately, over 90% of startups fail. And the top 3 reasons for that are often quoted as market fit, running out of money, and 3, not having the right people. But when it comes down to it, in my experience, and that includes yours truly, founders tend to struggle often with one of the main things they tend to struggle with is to make sense of their numbers. That's why we do this. And that's why we have had just over 700 sessions in over 4.5 years with panels like those ones today, that, myriad of successful founders, seasoned operators like the 3 finance specialists today, and of course, savvy investors too. But for now, I wish you all a brilliant holiday and a great break. Please take some time to recharge with your and spend some time with your loved ones rather than just work. And if you celebrate them, have a very Merry Christmas and a very, very Happy New Year. Remember, the startup journey can be both exciting but also challenging. So again, try to have some fun, especially now during Christmas, and be kind to yourself and everyone else for that matter too. Otherwise, thank you. God bless.